So, Bank of America has just dropped a pretty bold new forecast for the Indian stock market, looking all the way out to 2026. And what they see is this really fascinating mix of huge potential and some pretty significant risks. So let's dive right in and break down their entire outlook.
That's the actual title of their research report, A Flicker of Hope. And that name, it just perfectly captures the feeling here. There's this sense of optimism, for sure, but it's a fragile one. It kind of hints that a lot of things need to go just right for this forecast to actually play out. So what exactly are they hoping for?
Okay, here's the headline number. Bank of America is setting a target for India's main stock index, the Nifty, to hit 29,000 by the end of 2026. I mean, that's a big attention-grabbing figure that definitely suggests they have a pretty bullish outlook for the next couple of years.
Now, to put that 29,000 target into perspective, we're talking about a potential upside of over 11% from where we are today. But here's the really crucial part. BofA is very, very specific about how we get there. And let me tell you, it's probably not the way you might think.
And that's where we run into the core problem. See, the Indian market isn't cheap, not at all. In fact, you could say it's priced for perfection, which just means investors are already expecting a whole lot of good news. So this sets up the central question, right? How can the market possibly go higher if it's already this expensive?
All right, so just how expensive are we talking? Well, the Nifty is trading at 21 times what analysts expect companies to earn next year. And that +1 SD you see there, that's just a fancy way of saying it's already in the top tier of its historical price range. Think of it like this. The market's already getting an A grade. It's really, really hard to get an A+. There's just very little room for it to get any pricier.
So, this leads to an absolutely crucial point. If stocks can't really get more expensive, what the pros call valuation expansion, then there's only one other way for the market to go up. The growth has to come from companies actually making more money. It has to be driven by real earnings, not just investor hype.
And this illustrates BofA's core argument perfectly. They're forecasting that after a relatively slow year of 7% earnings growth, corporate India is going to hit the accelerator. We're talking about doubling that growth rate to 14% the following year. This projected surge in earnings is the entire foundation that their 29,000 Nifty target is built on.
Okay, so if the growth is all about earnings, where should investors be looking? This is where Bank of America's strategy gets really interesting. They drill down into this fascinating split in the Indian economy. They call it a tale of two consumers, where different income groups are having vastly different experiences.
And these numbers put that story into stark perspective. A massive 74% of Indian households fall into that low to middle income category. This is the mass market we're talking about. And the report points out that this segment has been struggling with savings going down and debt going up, which of course directly hits their spending power.
So this creates a really clear split for investors. On one side, you have the mass market, everyday things like staples, basic footwear, entry-level two-wheelers. Demand there is soft. But on the other side, the well-off consumer is absolutely thriving. Spending on jewelry, travel, and premium cars is showing some really strong momentum. Understanding this split is the key to BofA's whole playbook.
And here is that playbook laid right out. BofA is overweight, which just means favorable, on sectors that tap into that thriving, well-off consumer. They also like areas that tend to benefit from lower interest rates like financials and real estate. Now, on the flip side, they're underweight or cautious on pretty much anything tied to the struggling mass consumer, plus big global sectors like IT and steel that are facing their own headwinds.
Of course, no forecast ever exists in a vacuum. There are a bunch of major events and external factors, both good and bad, that could completely change the game in 2026. So let's move on and see how BofA is mapping out these wildcards.
Okay, this shows us the potential good news, the tailwinds on the horizon for 2026. Early in the year, the union budget could spark some growth. Then comes the big one, potential interest rate cuts from the U.S. Federal Reserve. Add in a calmer domestic political scene and a potential pay boost for government workers, and you've got a pretty decent recipe for optimism.
Let's just double-click on those Fed rate cuts, because this is a massive potential tailwind. Historically, when the U.S. cuts rates, it's like a wave of money from foreign institutional investors, or FIIs, floods into emerging markets like India. BOA believes this could be the key to reversing that recent trend of foreign money actually leaving the country.
But it's not all smooth sailing. BofA also flags 4 major headwinds: any delay in a key trade deal with the U.S., a sudden spike in oil prices, a weakening rupee, or, and this is the big one,
a major downturn in the U.S. stock market. Any of those could derail this whole optimistic forecast.
And this slide shows you exactly why a U.S. downturn is such a massive risk. Just look at this. For the last 15 years, the Indian and U.S. markets have moved in almost perfect lockstep, a staggering 97% correlation. It's a powerful reminder of that old saying, when Wall Street sneezes, the world, and that includes India, tends to catch a cold.
So, after weighing the expensive valuations, the hopes for an earnings rebound, the diverging consumers, and all those global wildcards, how in the world does Bank of America land on its final number?
Well, it all boils down to this simple but absolutely crucial calculation. They project a specific number for 1 year forward earnings per share, which is $14.38. They then multiply that by a target valuation multiple of 21.5 times. That's that same +1 standard deviation level we saw earlier. You put them together, and you get their nifty target of around 29,000. It all hinges on both of these things happening: strong earnings growth and the market maintaining its expensive valuation.
Which brings us right back to where we started. The forecast is ultimately a bet. It's a bet that Indian corporate earnings can accelerate enough to justify the market's high price tag. It's a bet on that flicker of hope igniting into real, tangible growth. So the big question for 2026 is, will it actually deliver?